Today, JP Morgan Chase stands as America's largest bank, with over $3.7 trillion in assets. But behind that gleaming corporate facade lies one of the most dramatic stories in American finance. A tale of ambition, crisis, controversy, and power that spans over 200 years. This isn't just the story of one bank. It's the story of America itself, told through mergers, panics, wars, and the outsized personalities who shaped the modern financial system. Our story begins not with banking, but with water. In 1799, Aaron Burr, yes, the same Aaron Burr who would later kill Alexander Hamilton in a duel, founded the Manhattan Company, supposedly to bring clean water to New York City. But Burr had other plans. Hidden in the charter was a clause allowing the company to use surplus capital for any business it saw fit. Burr immediately pivoted to banking, creating what would eventually become Chase Bank. It was a political move designed to compete with Hamilton's Federalist banks, and it set the stage for centuries of financial rivalry in America. Meanwhile, across the Atlantic, another banking dynasty was taking shape. In 1838, American banker George Peabody established himself in London. His partner? Junius Spencer Morgan, whose son would become the most powerful banker in history. John Pierpont Morgan, J.P. Morgan, was born into banking royalty in 1837. After training in Europe, he returned to New York in 1857, arriving just in time for a financial panic. While others panicked, Morgan saw opportunity. By 1871, he had formed Drexel, Morgan & Company, which would later become J.P. Morgan & Company. Our third thread begins in 1823, when the New York Chemical Manufacturing Company was founded. Like the Manhattan Company before it, it soon discovered banking was more profitable than its original business, becoming the Chemical Bank of New York. The late 1800s were the age of titans: Carnegie, Rockefeller, Vanderbilt. But J.P. Morgan would become the titan of titans. He didn't just move money, he reorganized entire industries. Morgan pioneered Morganization, the practice of restructuring failing companies and entire industries. He reorganized railroads, preventing destructive competition. He merged steel companies into U.S. Steel, the world's first billion-dollar corporation. When you needed capital for something truly massive, you went to 23 Wall Street. But Morgan's finest hour came in 1907. When a financial panic threatened to destroy the American economy, there was no Federal Reserve to intervene. There was only J.P. Morgan. Morgan, now 70 years old, locked the nation's leading bankers in his library and refused to let them leave until they agreed to pool their resources to save failing banks. He personally decided which institutions would survive and which would fail. For several weeks, J.P. Morgan essentially was the central bank of the United States. This crisis revealed both the genius and the danger of concentrated financial power. It also led directly to the creation of the Federal Reserve in 1913. Morgan had become too powerful, and America decided it needed a central bank instead of a central banker. The Great Depression changed everything. In 1933, the Glass-Steagall Act forced the separation of commercial and investment banking. J.P. Morgan & Company had to choose. Would they take deposits or would they underwrite securities? They chose deposits, becoming J.P. Morgan & Company, a commercial bank. But they spun off Morgan Stanley to handle investment banking. For the first time in a century, the House of Morgan was divided. While Morgan dealt with regulations, Chase was growing. In 1955, Chase Bank merged with the Bank of the Manhattan Company, remember Aaron Burr's water company, to become Chase Manhattan Bank. Under the leadership of David Rockefeller, yes, that Rockefeller family, Chase became a symbol of American financial power during the Cold War. Rockefeller transformed Chase into America's most international bank, opening relationships with China and the Soviet Union when few others dared. The iconic Chase Manhattan Plaza became synonymous with global capitalism. Meanwhile, Chemical Bank grew steadily through the mid-20th century, known for innovation. They installed the first ATM in America in 1969 and pioneered computer banking. They weren't flashy, but they were profitable and efficient. As the 1980s gave way to the 1990s, American banking hit a turning point. Deregulation was picking up speed, and a tidal wave of mergers was reshaping the entire financial landscape. In this era, the real question wasn't if banks would merge, but who would merge with whom. And at the center of this consolidation storm was the future of what would eventually become J.P. Morgan Chase. In 1991, two major New York institutions, Chemical Bank and Manufacturers Hanover, joined forces. This wasn't a small deal. Their merger instantly created the second largest bank in the United States, setting the tone for the decade ahead. Chemical Bank now had the scale and muscle to keep competing in an industry where size was becoming everything. Fast forward to 1996. Chemical Bank struck again, this time merging with the legendary Chase Manhattan Bank. On paper, Chase was the older, more prestigious name. That's why the combined company kept it. But behind the scenes, it was Chemical's management team that actually took control. The result, a bigger, more competitive institution, still called Chase Manhattan, but with Chemical steering the ship. Then came 1999. After decades of debate, Glass-Steagall, the law that separated commercial banking from investment banking, was finally repealed. For J.P. Morgan and Co., which had been forced to split its business back in the 1930s, this changed everything. The barriers were gone. The House of Morgan could finally rebuild itself. And that leads us to the defining moment. In 2000, Chase Manhattan merged with J.P. Morgan and Company, creating J.P. Morgan Chase & Co. After 67 years apart, the divided pieces of the Morgan empire were reunited. Two of the most storied names in American finance came together, forming a modern financial superpower that continues to dominate global banking today. September 2008. The global financial system was in freefall. Lehman Brothers had collapsed. AIG was seconds from bankruptcy. Credit markets froze. It felt like the entire economy was standing on the edge of a cliff. But while many financial giants were imploding, J.P. Morgan Chase was doing something different. It was getting stronger. At the center of this moment was CEO Jamie Dimon, who took over the bank in 2005. Dimon had spent years warning about excessive risk-taking on Wall Street, and now the storm he anticipated had arrived. During the panic of 2008, J.P. Morgan Chase made two of the most consequential acquisitions in modern financial history. First came Bear Stearns, which it bought for just $10 per share, with emergency support from the U.S. government, after the investment bank came within hours of collapse. Then came Washington Mutual Acquisition, which was seized by regulators and sold to J.P. Morgan Chase for $1.9 billion, marking the largest bank failure in U.S. history. These weren't traditional acquisitions, they were rescues, engineered by the federal government. In Washington's eyes, J.P. Morgan Chase was one of the few institutions strong enough to absorb these failures without collapsing itself. But with that strength came scrutiny. As J.P. Morgan Chase grew larger and more dominant, it became a symbol of a new phrase that entered the public vocabulary: too big to fail. Banks so enormous and interconnected that if they went down, the entire financial system would go with them. And J.P. Morgan Chase's post-crisis record wasn't without controversy. First came the London whale loss, which was a disastrous derivatives trade that racked up $6.2 billion in losses. Second was the mortgage-related fines, in which it paid billions of dollars paid to settle claims tied to the very crisis-era mortgages that destabilized the system. Then came the ongoing structural debates that politicians, economists, and regulators continue to argue. Should any bank be this large? Should a single financial institution wield this much influence? Across more than a century, the bank has survived, and often shaped, every major shift in the global economy. From the breakup of the House of Morgan, to the deregulation wave of the 80s and 90s, to the chaos of the 2008 financial crisis, J.P. Morgan Chase didn't just adapt to change. It used those moments to grow bigger, more influential, and more essential to the world's financial system. Today, it is the largest bank in the United States, a cornerstone of global markets, and a powerful symbol of both stability and controversy. To some, it represents smart leadership, discipline, and resilience. To others, it's the clearest example of a financial system where the biggest players wield too much power. But whether you see it as a stabilizing force or a product of a system that encourages bigness, one thing is undeniable. JP Morgan Chase is the result of every crisis, merger, policy shift, and personality that came before it. A bank built through opportunity and upheaval, reflecting the story of American capitalism itself. And its influence isn't fading anytime soon.